When you see a corporate financial report, it's easy for your eyes to just glaze over, right? All those numbers, the fine print, it can seem pretty dense. But what if I told you they're actually detective stories, full of clues about a company's health, its ambitions, and sometimes its hidden challenges? So today, let's crack one of these cases wide open.
That's the big question, isn't it? We see the headlines about profits and losses all the time, but how do you really know what's going on behind the scenes? How can you be sure the numbers you're seeing are telling the whole story? Well, in this explainer, that's exactly what we're going to do. We're going to look right past the headlines and dig into the details.
So the company we're looking at today is Amber Enterprises. They just put out their quarterly financial results and, at first glance, it seems pretty straightforward. But there's a fascinating split in their story. It's really a tale of two very different reports, and it reveals a company that's moving at absolute lightning speed.
Okay, so here's how we're going to break this down. First, we'll cover the basics of what a company's financial report card even is. Then we'll look at a red flag that the auditors raised. We're going to unpack what that red flag actually means, check out the company's insane growth lately, and then we'll tie it all together, see what it really tells us.
All right, first things first. The easiest way to think about a financial report is like a report card for a company. Simple enough, but with big companies like this, there's a twist. They often get two report cards. And understanding the difference between them, well, that's the key to this whole story.
So, on one hand, you have the standalone results. Just think of that as the report card for the parent company, Amber Enterprises itself, and nothing else. But on the other hand, you've got the consolidated results. This is the big group report card. It's for the entire family, the parent company, plus all the smaller companies and businesses that it owns or controls.
Okay, so if the financials are the report card, who's the teacher grading it? In the world of finance, that's the independent auditor. Their job is to be the watchdog, to go through the numbers and tell investors, hey, you can trust this. And in Amber's case, that watchdog found something worth flagging.
So an auditor can basically give two kinds of grades. The first one is an unmodified report. That's like getting straight A's. It means everything checks out, all clear, the numbers are solid. But a qualified report, that's a whole different story. It's like the teacher hands back your homework with a note that says, this is incomplete. It means the auditor is raising a little red flag, saying, look, most of this seems fine, but there's this one specific area where we just couldn't get enough information to sign off on it.
And boom, here it is. This is the key clue, pulled right from a note in their own financial statement. The standalone report card, just for the parent company, got a clean bill of health, an unmodified report. But the consolidated report card for the whole family got that qualified report, that incomplete grade. So the big question is, why?
And you can literally see the difference right here. On the left, you see the auditor's conclusion for the standalone report. It's clean, no issues raised. But then you look to the right at the consolidated report, and there it is, spelled out, a qualified conclusion. The auditor is telling us that for the group as a whole, the picture isn't quite complete. Okay. Time to put on our detective hats. What exactly was the problem here? Why couldn't the auditor give the whole corporate family a clean grade? Let's follow the money and see exactly what their note says. This is the question we need to answer. If it's an incomplete grade, what exactly was the missing homework? What's the piece of the puzzle that the auditors couldn't find? Luckily, their report tells us exactly what they couldn't review. And here are the specifics. The auditor points out that the financial results for one of their subsidiaries and one of their joint ventures were not reviewed by anyone. The company's management provided the numbers, but the watchdogs, the auditors, never got a chance to actually verify them. And we're talking about millions of rupees in revenue, and more importantly, a really significant loss. Yeah, let's just focus on this number for a second. That's a loss of nearly 18 crores of rupees. And it's coming from just one part of the business that no independent auditor officially checked. So you can see why they had to issue that incomplete grade, right? When a number that big is unverified, it's kind of a big deal. So you have to ask yourself, how does this even happen? Well, it didn't just happen in a vacuum. To really get why parts of the company weren't reviewed, you have to understand the bigger picture. Amber's been on an absolutely massive aggressive expansion, and that is key to this whole story.
Just look at this timeline. We're talking about just a few short months in 2025. They started a new joint venture, they bought a company in August, another one in September, and yet another one in December. This is a company that's not just growing, it's practically inhaling other companies.
And these weren't small purchases either. The price tag for just one of these companies, Power One Microsystems, over 410 crores.
And do you think that's a lot? For Shogini TechnoArts, it was even bigger. We're talking over 600 crores. They are pouring huge amounts of money into getting bigger and doing it incredibly fast. So the obvious question is, where is all this money coming from? Well, right in the middle of this buying spree, they went out and raised nearly 1,000 crores from big institutional investors. They basically got a massive tank of jet fuel and slammed the pedal to the floor on their expansion plans.
All right, let's tie this all together. We've got the two different report cards. One is totally clean. The other has that big incomplete stamp on it. And we've got this story of a company expanding at breakneck speed. So how do these two things connect?
This table right here, this really says it all. Look at the standalone column. That's just the parent company. For the quarter, it was profitable, made over 42 crores. Looks pretty good. But then you look at the consolidated column. When you add in the whole family, all the new subsidiaries and joint ventures, the whole thing flips to a loss of over 27 crores. Now you see why that auditor's note matters so much. A big, unverified chunk of that consolidated picture is where a lot of the action is.
So what's the bottom line here? It's actually pretty simple. That incomplete grade from the auditor isn't some random mistake. It's a direct consequence of the company's own strategy. They are growing so fast, buying so many new companies, that their business has become incredibly complex. So complex that it seems the auditors just couldn't check every single moving part in time for the quarterly report.
And all of this leaves us with a really fundamental question, one that every fast-growing company and its investors has to wrestle with. When you're in a race to expand, what's more important? The sheer speed of that growth or the strength of the governance that makes sure every number is checked and every process is followed? There really is no easy answer, but it's the central tension right at the heart of Amber's financial story.
Okay, so let's unpack this. Usually when we talk about reading a story, we're talking about a novel, a biography, maybe a screenplay.
Right.
But today, we are reading a story written entirely in red-green bars. And honestly, it's got more drama than most things on Netflix.
It really is a story without words. But the plot twists, they are violent. If you know how to read the language, it's a genuine thriller.
We are looking at a single, dense, technical chart. It's for a stock called Amber on the NSE, the National Stock Exchange. And for you listening, try to visualize this with us. It's like the blueprint for the world's scariest roller coaster. You have this long, beautiful, steady climb, then a drop that looks like the track just, vanished into thin air. And then right at the very end, this vertical rocket launch that just seems to defy physics.
It is a textbook example of market psychology playing out in real time. We often think of the stock market as this cold, rational machine.
Yeah, algorithms and all that.
Exactly. But when you look at a chart like this daily chart for Amber from April 2025 to February 2026, you realize it's actually a map of human emotion. It's a map of panic, greed, and regret.
And that is exactly our mission for this deep dive. We're going to decode this chart. And I mean, I'm looking at it and it's intimidating.
It can be.
We've got candlesticks, these wavy green lines called Bollinger Bands, volume bars. It looks like the dashboard of a spaceship, but we're not going to get bogged down in, Wall Street jargon.
No, absolutely not. The whole point is to translate those bands and wiggles into what they actually mean.
Okay.
Human behavior. It's buyer conviction versus seller fear.
So let's strip away the noise and look at the narrative arc here.
Yeah.
Because this chart really does have a three-act structure, a tragedy that turns into a redemption story.
Or maybe a crime scene that turns into a miracle.
Exactly. So let's start at the beginning. Act 1, the setup. If we look at the left side of this chart, back in April 2025, life looked pretty good for Ambia shareholders, didn't it?
It was a very comfortable place to be. If you look from April all the way through September 2025, the stock was in what we call a healthy uptrend. It started down in the 5900s. And if you just trace your finger along the chart, it's just a steady march upward.
I see that. It's not vertical, though. It's sort of jagged but rising.
Right. It's creating higher highs and higher lows. It steps up, takes a breath, steps up again. It's consistent.
And I see the scale on the side. It hit a peak around September. Looks like the high was roughly 82.28.
That's correct. 82.28 was the summit. But I want you to look at how it got there. Do you see that red wavy line running through the center of the price candles?
The red line, yeah, it sort of snakes through the middle. That's the moving average.
Precisely. Think of the moving average as the consensus of value. It's the average price over a certain period. During that climb from April to September, notice where the price candles are sitting relative to that red line.
You're floating above it. That's almost like they're surfing on it.
That is the perfect analogy. In a strong uptrend, that moving average acts as a floor. We call it support. Every time the price dips a little, it hits that red line, and buyers step in because they think, oh, it's cheap now, it's back to the average.
So it bounces back up.
Yeah.
So the red line is like a safety net.
Exactly. It tells you that the average sentiment is positive. Investors are happy, the mood is optimistic, gravity seems to be working in reverse.
So if I'm an investor in, say, August 2025, I'm looking at that red line and thinking, as long as we stay above this, I'm golden.
You're feeling brilliant. You're checking your portfolio app at dinner and buying rounds of drinks for your friends. But this is where the plot twist comes in, because markets are designed to fool most people right when they feel the safest.
Enter Act 2, the crash. And looking at this chart, crash feels like the right word. It starts in October 2025.
It does. And notice the visual shift. It's not a gentle slide. Visually, the angle of the line changes completely. It goes from a nice 45-degree slope up to, well, almost a vertical drop down.
It looks like someone cut the elevator cable.
And here is the critical technical event that signals the disaster. Remember our friend, the red moving average line? The surfboard.
Yeah.
The surfer fell off. In October, the price candles drop below the red line. And this is crucial for anyone trying to understand charts. Once the price breaks below a key average, the psychology flips upside down.
How so? I mean, it's just a line, right?
It's a line that represents the average price people paid. When the price is below the average, it means the average holder is now losing money. So that red line, which used to be a floor,
It's a support
it flips. It becomes a ceiling. It becomes resistance.
because people are just trying to get out.
Exactly. Every time the stock tries to rally during that winter period, it hits that red line from below and just gets smacked back down. It's like hitting your head on a low ceiling. Traders often call this the Red River. You do not want to be swimming in it.
It looks painful. I mean, we went from a high of 82.28 in September, and we just kept bleeding out until the bottom there. Late January 2026.
Late January, yes. The chart indicates a low of roughly 47.39.
Whoa, wait, let me do the mental math on that. From over 8,200 to 4,700, that's nearly a 50% drop.
It's a massive destruction of value in a very short period. Imagine you put $10,000 into Amber in September. By late January, you're staring at $5,500.
That's brutal.
That isn't just a correction, that is capitulation.
Okay, explain capitulation for someone who might not be a trader. Is that just a fancy word for panic?
It's panic with a specific flavor. It's the end stage of panic. Capitulation is when the pain of holding the stock becomes greater than the feel of losing more money. It's when the last believer gives up. They say, I don't care what the price is, just get me out, I can't sleep.
So effectively, the chart is telling us that in late January, the market reached maximum misery.
Maximum pessimism. Everyone thinks it's going to zero. And paradoxically, that is exactly when you should be paying the most attention. Because when there's no one left to sell,
The only way to go is up.
there you go.
Which brings us to the most dramatic part of this image. Act 3, the resurrection. Or the V-shape, as I'm seeing it here.
It is a violent V-shape. And I use the word violent on purpose. Most recoveries, they take time. They look like a U. The stock goes sideways, it heals.
Right, it licks its wounds.
Exactly. This didn't heal, it just snapped.
It's almost startling. We hit that bottom near 47.39 in late January, and then, boom, a straight line up. In just a matter of weeks, it undid months of damage.
It's like holding a beach ball underwater. You push it down, that's the selling pressure. But the moment you let go, it doesn't slowly float up, it rockets out of the water.
I want to focus on where we are right now, the specific day this chart captures, because there is a massive green candle on the far right that looks bigger than anything else on the screen.
The monster candle.
Is that the technical term?
In the industry, we might call it a Marubozu or a trend candle, but yeah, monster fits the vibe. Let's look at the specific data points in the legend at the top left because the numbers tell their own story.
Okay, read them out for us.
So we have the open, that's the price at the morning bell, which was 7299.00.
Okay, 7299.
The low for the day was 7172.50, so at some point it dipped a little, maybe some nerves early on. But look at the high and the close. The high was 7517.0, and the close, 7495.7.
Wait, so the close was 7495.50, and the absolute highest it got was 7517. They're almost the same number.
They are very close, and that matters immensely.
Why? I mean, a few points here.
Because it tells us about conviction. If a stock shoots up but then falls back down before the close, it leaves a little wick at the top of the candle. That upper wick represents seller stepping in, taking profits. It shows hesitation.
But this candle doesn't really have a wick at the top. It's just, it's a solid block of green.
Exactly. It closed very near its high. That means buyers were buying right up until the final second. There was no hesitation, no profit taking, just pure, unadulterated demand. The sellers couldn't push it down. That is a sign of extreme strength.
So the panic of January is completely flipped into fear of missing out.
Absolutely. The psychology has inverted. In January, they were terrified of holding. Now they are terrified of not holding.
But, and here's where I have to play skeptic. How do we know this isn't just hype? I mean, things go up, things go down. Is there something mechanical driving this? Because looking at the chart, there are these other lines, the engine under the hood, that seem to be screaming.
You're right to be skeptical. A price move is just a price move unless it's confirmed by other signals. And this chart is lighting up like a Christmas tree. Let's look at those green wavy lines that sort of envelop the price candle.
The Bollinger Bands. I've always loved the name. Bollinger Bands. Sounds like a 1920s jazz group. And now, ladies and gentlemen, the Bollinger Bands.
It does have a ring to it, doesn't it? They were invented by John Bollinger. Think of them as a dynamic container for the price. When the bands are wide, volatility is high. When they squeeze together, the market is quiet. But more importantly, they act as a statistical boundary. 95% of price action usually happens inside the bands.
Okay, so it's like the guardrails on a highway. You're supposed to stay between them.
Exactly. But look at what the price is doing right now relative to that top green line.
It's punching through it. The green candle is actually poking out the top of the band.
That is significant. We call that a volatility breakout. The price is moving so fast with such intensity that it is literally stretching the statistical boundaries of the stock's normal movement. It's breaking the envelope.
Is it good? Breaking the guardrail sounds dangerous.
It depends on your time frame. In the short term, it signals immense power. It says the inertia of the move is so strong that the normal rules are being bent. It often happens at the start of a massive new run.
Okay, so the Bollinger Bands are screaming, breakout! What about our old friend, the red line, the moving average?
This is the second critical signal. Remember how I said during the crash the price was stuck below the red line?
The Red River, yeah.
Look closely at the V-shaped recovery. The price didn't just touch the red line. It sliced right through it.
I see it. It slashed right through it on the way up.
That crossover is a change in regime. It's the technical equivalent of the sun coming out after a long winter. The ceiling has been shattered. Now, if the price were to dip, we would expect that red line to act as a floor again, just like it did back in mid-2025.
So we've got a volatility breakout, and we've recaptured the moving average. But I want to look at the middle graph for a second, that purple line. That's the RSI, right?
The Relative Strength Index, yes.
I like to think of this as the speedometer of the stock.
That's a good analogy, but it also measures overextension. The scale goes from 0 to 100. Below 30, a stock is oversold, beaten down too much. Above 70, it's overbought.
Okay, so looking at the chart, back in January, during the crash, that purple line was way down at the bottom.
Correct. Deeply oversold. It was screaming that the selling had gone too far. But look at it now.
It's pointing almost straight up, angling sharply toward the top.
It has crossed the midline, the 50 mark, and is heading toward that upper zone. This confirms momentum. It tells us it's not just the price floating up on thin air. The internal strength of the move is accelerating. The engine is revving hard.
But, and I feel like there's always a but, how do we know this isn't a fake out? We've all heard of the dead cat bounce, where a stock falls, bounces a little, traps everyone, and then keeps crashing. How do we know this isn't that?
That is the single most important question you could ask. And to answer it, we have to ignore the price for a second and look at the bottom of the chart, the volume.
The vertical bars at the very bottom.
Yes. In technical analysis, we have a saying, price without volume is a lie. Price with volume is the truth.
Ooh, I like that. The truth serum.
Precisely. If the price goes up but nobody is actually trading, if the volume bars are tiny, it means there's no conviction. It's a hollow move. But look at the far right of the volume graph.
There's a spike. A big green bar that towers over the ones before it.
It aligns perfectly with our massive price jump. That green spike means volume is flooding in.
So this isn't just a few day traders messing around on their lunch break.
No. A volume spike of that magnitude usually indicates institutional participation. Big money, mutual funds, hedge funds. The fact that this rally is backed by that tall volume bar validates the move. It says, we mean business.
So let's try to synthesize all of this, because we've covered a lot of indicators, and I want to make sure I'm seeing the whole picture.
Let's put it together.
We've got the price crossing the average. That's the regime change. We've got the breakout through the Bollinger Bands. That's the explosion. We've got the rising RSI. That's momentum. And we've got the volume spike, the truth serum.
When you see all those signals firing at the same time, it's a very powerful setup. It's a symphony of indicators.
And seeing this on the Nuvama display really highlights that clarity. But I want to ask about the context. We're trading at 74.95, points 50 more. We came from 47.39, but we are still below the all-time high, right? That 8228 number.
We are, and that is an important distinction. We have recovered a significant chunk of the losses, but we aren't at new highs yet.
So what's going through the mind of a trader looking at this right now? What's the internal conflict?
It's a battle of two emotions. If you are smart or lucky enough to buy at 4,700, you are sitting on a massive profit. You might be tempted to sell. But if you are watching this momentum, seeing that volume, seeing the breakout, you're afraid that if you sell now, it's going right back to 8,200 without you.
FOMO.
Exactly. The chart captures that psychological journey perfectly. Panic selling in January created the low. And now the fear of missing the recovery is fueling this vertical ascent.
It really is a map of human emotion, isn't it? Just drawn with red and green lines.
It is. The numbers change, the ticker symbols change, but human nature doesn't. That's why these patterns repeat.
So we've seen the rise, the devastating fall, and this phoenix-like rising from the ashes here in early 2026. Amber has been on quite a journey.
It has been a volatile year for Amber shareholders, to say the least.
Before we wrap up, I want to leave the listener with something to chew on. We've talked about how strong this move is. But is it too strong?
That brings up the concept of sustainability. If you look at the angle of the current rise, it is nearly vertical. In physics and in markets, vertical moves are rarely sustainable without some kind of pause.
Because you run out of energy.
You run out of buyers. Eventually, everyone who wants to buy has bought. The candles are currently punching through the green ceiling, the Bollinger Band. That usually signals an extreme state. The question for you listening to this isn't, did it go up? We know it went up. The question is, can it stay up?
Right. What happens when gravity tries to assert itself again?
Exactly. Markets breathe. They inhale and exhale. This chart is currently taking a massive deep inhale, but eventually it has to exhale. The test will be whether it can hold on to these gains when that happens.
That is a fascinating thought to end on. Look at your charts, everyone. Not just as math, but as maps. Maps of where the crowd is running.
And remember to always check the volume. It's the only way to know if the crowd is telling the truth.
Thanks for diving deep with us today into the Pulse of Price. We'll catch you on the next one.